Welcome to the first episode of Quest for Twice in 2024. Today is January 30th. Today I'm going to cover the earning update from Kinder Morgan. Then I'm going to do a deep dive into a new company I have been researching. So Kinder Morgan reported a little soft earning in the fourth quarter last year. The full year EBITDA was 7.6 billion in 2023. However, the management gave a pretty strong guidance for 2024 with EBITDA of $8.2 billion. The increased EBITDA guidance was partially driven by the recent acquisitions of STX for $1.8 billion closed in December last year. Just a reminder, Kinder Morgan spent $1.2 billion in 2021 to buy Stagecoach. So as a result, I anticipate the 2024 DCF will be about $5 billion, a step up from $4.7 billion in 2023. The management also gave a guidance about the capex for the amount of roughly $2 billion in this year. So at $17.3 per share, the forward dividend is about 6.6%. And the 5 billion DCF is enough to cover the capex and the forward dividend combined, with about $400 million left. So the management spent about that amount for buybacks in 2022 and about $500 million for buyback in 2023. So I anticipate the management will do the same with the surplus DCF once capex and dividend are paid. Now let's look at MarineMax. It's the world's largest recreational boat, yacht, and superyacht services company. 69% and 8% of last year's revenue came from new and used boat sales, as shown in the pie chart on the right. And 7% of the revenue last year from storage and charter segment. To round up the rest of the segments, they include brokerage sales, parts and accessories, maintenance, repair and services, and finance and insurance. This chart is a giveaway why I'm interested in MarineMax as an investment. So we can see its revenue started with less than $500 million in 1998. Then had a peak around 2007 for the amount of $1.2 billion. Then had a significant decline in the 3 years after, reached a nadir of less than $500 million in 2010. From there, the revenue started to climb again and reached a high about $2.4 billion in last year. Its gross margin, as shown as the purple line on the chart, was pretty steady around 25% during the years before the pandemic, with the exception of 15% in 2009. Then during the pandemic and afterwards, its gross margin shot up, and last year stayed above the 33%. Also, its return on invested capital had a negative number in 2008 and 2009, but then steadily recovered. Before pandemic, it was steady around 10%. Then shot up significantly during and after the pandemic. So obviously, its sales and the margin benefited from the pandemic. That's because people wanted to go outdoor more and stay on the water, enjoy themselves during the lockdowns and isolations. Then the question is, will gross margin drop back and sales growth decelerate since the pandemic is now over? So let's take a look at the margin versus segments. To give a bit of background information, there is a very busy chart on the top right. It's difficult to see the details, but the point is MarineMax has been a serial acquirer of businesses since 2019, especially marinas and super yacht services. With that context, we can look at the chart on the bottom right. The column shows the revenue contribution from different segments in terms of percentages. So they add up to 100%. Then the other line shows the gross margin since 2017 to the most recent quarter. Keep in mind that the MarineMax has a fiscal year ending on September 30th of each year. So its first quarter 2024 actually ended on December 31st of 2023. Obviously, the chart is quite busy. So the key point I want to point out is the bottom two colors, brown and yellow. Those are the combined sales contribution from new and used boat sales. So we can see that in 2017 and through 2020, they combined to have more than 85% of total sales. Then that combination started to decline in terms of revenue percentage. So in the most recent quarters, they combined less than 75% of total sales. And in the meantime, the gross margin increased since 2020. That coincided with less contribution from new and used boat sales. So the key takeaway is the gross margin may be expanded by higher sales outside the boat sales, especially storage and the charter segment. Now let's take another look about the pandemic impact. This chart shows the same-store sales. Those are the gray bars since fourth quarter 2018. And the year-on-year sales, that's for all the segments combined. I also plotted the gross margin as the red line. We can see that there was a little sales growth in the second quarter of 2020. Afterwards, the same-store sales just shot up over 28% for 4 quarters in a row. Then the same-store sales decelerated since third quarter 2021. However, the total year-on-year sales still grew in a pretty good pace until fourth quarter of 2022. and gross margin stayed above 30% since fourth quarter 2021. In the most recent quarter, the gross margin was 33.3%. The management pointed out that was lower than usual because of discounting they were offering. So the conclusion is higher boat sales in the 4 quarters during the pandemic were not the primary reason of a higher gross margin. It must be because of higher contributions from other segments made the gross margin go up and stayed high after the pandemic. So let's look at the other segment revenues closely. That's shown in the chart on the top right. So the three lines grouped together, that's the combined boat sales, including new, used, and brokerage sales. So we can see a very clear seasonal pattern with a peak in the third quarters, which ends on June 30th of each year. The bars don't have as strong seasonal pattern as the boat sales. Out of those, the biggest component is storage and charter. We can see a significant jump from first quarter 23, and that's because of a major acquisition MarineMax did in the quarter prior. Similarly, the maintenance and the repair, those orange bars, also grew in fiscal 2023 and the first quarter 24 compared to fiscal 2022. That was also because of acquisitions. The parts and the accessories segment, the brown bars, we also see a increase, again attributed to recent acquisitions. So the key takeaway is the storage, parts, maintenance, and repair were the growth drivers in recent years. Since we concluded earlier that the boat sales were not reason to drive a higher gross margin, then it must be those the remaining segments cause the higher gross margin. Therefore, we should have confidence that the gross margin should stay high going forward. Now let's look at the profitability. In this case, I'm focusing on EBITDA. So that's shown in the chart on the bottom right. I plotted the total sales for each quarter since first quarter 2022. Then I stacked the different components to show the EBITDA. Yellow bars are the adjusted EBITDA. On top of them, there are gray bars. Those are the stock compensations contributing to EBITDA because those are not the cash cost. On top of those, I also stacked floor plan interest payment. So we can see clearly since first quarter 2023, the interest payment has been increasing and become more significant in terms of total EBITDA. That's because of two factors. The first one is during the pandemic, MarineMax had very little inventory because the boats were in high demand. So as soon as they got new boats, they were sold. So they didn't need to carry much inventory. The second reason was because of the floor plan interest rate was tied to short-term borrowing rates. Therefore, before the recent inflation episode, the interest rate was very low. So Then the total interest payment was also low. However, that has changed. We can see in the first quarter of the 2024. The floor plan interest payment was actually about $10 billion. That's very significant comparing to $20 million of adjusted EBITDA. Now, let me examine its stock valuation. So the EBITDA after stock compensation was $215 million and $295 million in the last 2 fiscal years. We can see in 2023 was about a third less from fiscal 2022. That reflects the impact of a pandemic on its business. For fiscal 2024, management gave a guidance about $168 to $993 million. That's a $35 million reduction from prior guidance. So at the low end, it's about a 25% reduction from fiscal 23. At the end of last calendar year, its short-term debt was about $700 million, was secured by inventory of $876 million. It carried a long-term debt of $381 million, which is about 2.1x adjusted fiscal 24 EBITDA. At $28 per share, its market cap is about $590 million. Interestingly, the market cap is less than its inventory of $876 million. So the EV over EBITDA is about 5.4 if we exclude the short-term debt, and 9.3 if short-term debt is included. Cash flow from operations including inventory impact was about $130 million in fiscal 23. So my estimate of CFFO in fiscal 24 is about $95 million. Then we can use a market cap divided by CFFO, we'll get about 6.2. So let's summarize with the investment thesis and the risks. I see MarineMax as attractively priced with a track record of growth. However, there are some risks. The first one is both are consumer discretionary and subject to recession impact, especially since both are expensive. Those are major purchases and discretionary purchases. So they are even more vulnerable to people feeling insecure about their financial future. Second threat is high interest rate may depress demand and at the same time increase inventory interest cost. So that will be a double whammy on MarineMax business. The third threat is high inventory MarineMax has to carry to conduct its business. So at the end of calendar 2023, the inventory was worth of 1.5x of its market cap. So any impairment to inventory will reduce the value of the company. For example, MarineMax suffered $4 million damage from Hurricane Ian in fiscal 2022. Lastly, there is a threat of since MarineMax grew by mergers and acquisitions, then there is a risk that the management will overpay and waste shareholders' money. Just to put the numbers behind this statement, the management spent 41, 20, 134, 83, and $517 million since 2019 ending in 2023. As a context, the management also spent 28, 24, 0, 21, and $0 million in those 5 years for share buybacks. Of course, I do see one opportunity. That is, global warming may actually be good for MarineMax's business because that will increase the boating season. As a result, may increase long-term demand for boating. This concludes the first episode of Quest for Twice in 2024. Until next time, happy investing.